This is Tom Kozlik, the head of public policy and municipal strategy at HilltopSecurities. Thank you, everyone, for joining us today again for this episode of our HilltopTalks Politics and Finance podcast series for 2025. During these HilltopTalks podcast discussions, we speak with subject matter experts about topics that intersect the worlds of politics and finance at the federal, state, and local levels in the United States. We often concentrate on issues related to U.S. public finance and the U.S. municipal bond market. Today's episode is going to be the last that we're going to record for 2025. And we are very happy to have a return guest, what they call a friend of the pod, Tom Aaron from Moody's. Tom is a vice president and senior credit officer at Moody's. And Tom and his team have helped implement and maintain how it is that Moody's approaches public pension risk. Thank you very much for coming back to talk to us, Tom.
Well, thank you so much for having me back for a return visit. Really appreciate it.
Most people do not wake up thinking about pension discount rates, right? They might wake up thinking about things like groceries or rent or did you leave the coffee maker on? They'll think about school quality. To a lesser degree, sometimes folks will be thinking and or talking amongst themselves about whether their communities can maintain service delivery, right? I mean, that's a big public finance topic for sure. But to a degree, I'd say that public pensions sit in the middle, even though it might not necessarily be on the top of everyone's minds. Public pensions sit in the middle of those discussions. And when pensions are stable, they're relatively quiet. When they break, or like in the last decade, what we saw, they get loud pretty fast. Now, strong equity market returns over the last couple of years have helped, no question, but those strong equity market returns can also increase some vulnerability in my mind, especially if there's a dependence upon certain returns, and or if there's a dependence on certain types of investments. Today, we're going to talk about what is genuinely improving in the public pension area, because there are some things that have been improving. We're going to talk about where the exposure is, and we're going to talk about some of the issues and themes that those in public finance and municipal bond investors should be watching for in 2026 and beyond. So, from my perspective, Tom, the pension story in 2025, more or less, has been one that's been improving. Since the last time we spoke, since the last time we had you on the pod, at the beginning to the middle of 2024, your work has been showing that pension risk has fallen again in 2025. Can you walk us through a couple of reasons of why it is that, what happened and why that is?
Sure. So I'll focus on kind of just slicing and dicing it two ways to start. So the first is, maybe we'll just talk about it from a long-term balance sheet perspective. And, most U.S. public pension systems end their fiscal year on June 30. So, we're talking about, mid-year this summer when most of them took their year-end snapshots. We looked at, a number of factors, investment returns, for the fiscal year, as well as contributions and other assumptions. And we basically pegged unfunded pension liability. So we call it our adjusted net pension liability at just over $2 trillion. And that is down from about $6 trillion when it peaked June of 2020. So if you just step back and think about that for a moment, that is a substantial decline, both in percentage terms, but also just in raw nominal dollars. That's a $4 trillion cut to unfunded liabilities that sit on state and local government balance sheets.
And have the equity market returns that we've seen in the last couple of years, is that playing into that?
So yes, but a bigger part of that is actually discount rate changes.
Okay.
And, so we use a market-based discount rate that is basically tied to high-grade fixed income, interest rates. And unlike state and local government retirement systems, which will use their assumed rate of return as a discount rate. And so what has happened is discount rates have fallen, discount rates have come up so much that liabilities have fallen. And just to put this in context, we applied about a 2.7% discount rate June of 2020. June of 2025, that was up to about 5.6. So that has been the key driver to answer your question real directly, Tom. Yes, the equity market returns have certainly helped.
Mhm.
But as far as our sizing of the liability goes, it's been primarily discount rates that have really driven it.
So what I'm thinking about is that is as much, correct me if I'm wrong, but that could be looked at as though it's as much um, it's better on paper, right? I mean, so the key question to me is, did the plans truly get healthier, or is it that the kind of the measuring process changed? You pointed out that the discount rates have been a major driver of the lower reported liabilities. Um, Maybe let's look at it from this way. If this discount rates if they stayed what they looked like in 2020, how different would the picture look today?
The answer is not very.
Okay.
Compared to about 6 trillion in June of 2020, if you kept the discount rate constant, uh, we would peg the unfunded liability at about 5.8 trillion. So roughly unchanged is the answer. But I guess let's maybe use that to transition to kind of part two of my answer, Tom, which is you have to also look at the income statement. That's kind of a long-term balance sheet snapshot view. But on the income statement, I think there's actually some overwhelmingly positive news to relay. And that is contribution discipline has remained relatively strong, at least compared to what we saw in past years, where many state and local governments were really on an annual basis, shortchanging their contributions to pension systems. We've seen that dynamic improve very much. And it's one that, is really kind of an interesting thing to think about from the perspective of municipal credit. Because on the one hand, you immediately think, well, contributing more to pensions, that's actually harder on the budget. It's pushing expenses up. But on the other hand, shortchanging the pensions is akin to basically a structural deficit. And mathematically, it's kind of like borrowing from the pension fund. And so it's actually a very expensive way for a government to borrow is to shortchange their pension fund in the near term. And by and large, many governments have really improved their pension contributions. So I think from an income statement perspective, that is certainly something that is hard to say anything other than that risk has declined because governments are contributing a lot more and sooner to their pension systems.
So you said that they're contributing a lot more now.
Yes, relative to their actuarial requirements, relative to this metric we use called the tread water indicator, which is
Right.
basically testing whether they're actually paying off any of their reported unfunded liability. The prevalence of uh, tread water gaps is way down, and you can look to even a number of relatively high profile, for example, state governments that you would associate historically with a lot of pension pressure. New Jersey, Connecticut, for example, both have made substantial improvements in their pension contributions and over a multi-year period. So, I just named those as a couple prominent examples, but that
Right.
extends to many local governments as well. The amount of contributions that are below what that tread water indicator I talked about is way down, and the number that are very material is almost non-existent at this point.
So overall, it seems as though risks are lower, but in general, risks are not disappearing. It's just shifting to a degree. I mean, is that the right way to think about it? I mean, despite the positive developments that we've been seeing, what do you think is the most likely trigger that could uh, increase pension risk or make pension risk jump again for state and local governments, maybe like it did, about a decade or a little over a decade ago?
So without a doubt, I think the answer to that question is it's investment returns. So we talked a little bit about strong equity performance. You mentioned that earlier, and U.S. public pension systems asset allocations remain very much in what I would argue is a risk on mode. And by that, I mean they are heavily allocated towards equities and a variety of alternatives with comparatively low allocations to high grade fixed income securities that are matched to uh, the timing and amount of their liabilities. So there's not a lot of asset liability match there. And those asset allocations being so heavily allocated to kind of the growth assets, again, equities and alternatives, that brings with it volatility risk. And if we were to experience a big market downturn, kind of that calm, stable picture that you opened our discussion with describing, that could change pretty quickly and in a hurry if we were to get a big, one or a couple market losses. Because all of a sudden, the stability that governments have been enjoying in recent years in terms of their contributions, they would be called upon relatively quickly to start hiking their contributions to backfill the new unfunded liabilities that would emerge. So to sum up, by far and away, in our view, the most likely, or I should say, the highest risk out there, potential for state and local government pension systems to, really all of a sudden start being a big credit consideration again on the negative side would be if we get an investment downturn.
So, because I'm going to ask, I want to ask a question about asset allocation, then I'm going to ask you a question about crypto as follow up. As far as the asset allocation, uh, over the last kind of 5, 10 years, has the asset allocation to and exposure to equities increased? And are you expecting, I guess that's a first part for that question. The second part for that question, are you expecting that because the equity markets have performed, so uh, higher than most people expected in 2024 and 2025, are you expecting that asset allocation could decrease, or the exposure to equities could decrease in the near term?
So number one, overall, we've not seen a major uptick at all in public equity allocations. If anything, it's been a slight decline, but it hasn't been a shift to kind of high grade fixed income, as I mentioned earlier. Instead,
Yeah.
that has been joined with kind of a little bit of a higher allocation to some of the alternative asset classes. So, that includes private equity, private credit, um, real estate, and other kind of miscellaneous alternatives. So it's not on a whole been, a de-risking at all. It's just been a little bit of a shift amongst the growth assets from the more traditional public equity towards some of the alternative classes. But even that has not been what I would consider to be a very dramatic shift.
For a
So
large percentage.
yeah, from a huge percentage change. So it's really been more of just a modest shift. So just give a sense. We did a tally of the 100 largest U.S. public pension systems as of their most recent financial statements earlier this year. Public equities were about 42%. The alternatives that I described were about 34% of the allocation, and then fixed income and cash were about 24. So that's not a dramatic difference from years past, at least recent history.
What kind of exposure are you seeing to crypto like Bitcoin?
So that's been a bit of a new arrival on the scene, so to speak. We published an article earlier this year on digital asset exposure. Thus far, it has been, relatively small, uh, but the number of U.S. public pension systems expressing interest in it, either at the pension system level or kind of indirectly because their state legislatures have been considering legislation surrounding it, has been growing. There are a couple U.S. public pension systems that have already made direct investments in digital assets via ETFs that are tied to cryptocurrencies. These are not to date very large allocations at all, but I think it's certainly noteworthy that these U.S. public pension systems are expressing interest in them, and in some cases actually starting to allocate some small amounts of investments toward them.
Somebody from the outside might say, these funds are invested typically for long periods of time, decades. Um, why is it that you'd be so concerned about a bad year or two of investment returns? And I'm trying to help people understand why the investment volatility concept matters so much for public pension systems and ultimately how it could affect the budgets of the state and local governments and school districts that stand behind them.
Okay, I think that's a fantastic question, and it's because so often, due to sort of their long-term nature, the focus of U.S. public pension systems is really on the long-term ability to hit their return targets. But there's a couple of things beneath the surface that also mean the near-term matters. So number one, U.S. public pension systems are still what we would call demographically mature. That just means they're increasingly retiree heavy. And when a pension system is retiree heavy, that tends to be when it's paying out more in benefits than it's bringing in. We call that negative non-investment cash flow. And so basically paying out benefits more than is coming in from contributions means that if there's a down year in the investments, the asset corpus has to decline in order to keep benefit checks flowing out the door. And you combine that with the fact that even though their funding has improved, U.S. public pension systems still, by and large, are underfunded. They're not fully funded. So demographic maturity combined with an underfunded status means the susceptibility to volatility in annual investment returns is heightened because that volatility ends up constraining asset accumulation. So a more concise way of expressing this is there's risk associated with the sequence of returns. It's not just whether they hit their return target over the long term. It's the path that they take to get there that matters a lot too. And so if it's a bumpy ride of investment performance, that can easily result in much slower asset accumulation than if it's a stable one. And so because of that cash flow dynamic, the near term still matters quite a bit in terms of asset accumulation for a pension fund. And then that asset accumulation is what drives the budget, which I think is what you were alluding to in your question. So if the assets are not accumulating at the pace that is, assumed based on the actuarial assumptions, that ultimately means higher contribution requirements from government budgets.
Well, I'm going to widen the lens here for a second, and kind of what I was getting at, then this is kind of where you were going. If the markets fall at the same time that uh, overall revenues are softening, and or there's a little bit of a mismatch between spending and revenues. And what I'm thinking about is that the situation like what we're seeing in the K through 12 school district sector, right? Um, Even though overall economic growth is relatively strong, the K through 12 school district sector is having some issues. So those types of issues could be really complicated if there was kind of if the equity markets really dropped, and if there was kind of a pension shock that that K through 12 school district budget process would like collide with, right? That's kind of what you're talking about.
Well, I'm glad you brought that up. We haven't talked about another key piece of the equation that ties directly to municipal credit, and that is revenue growth.
Right.
In recent years, revenue growth has been quite strong, and that has kind of also enabled and made it easier for governments to keep those stronger pension contributions going that I mentioned before. So, unfortunately, it I think is likely that if you were to see a big market drop, there's a good chance that could be going hand in hand with a challenging revenue environment. And so, just at the time when governments would be called upon again to increase their contributions towards their pension funds to make up for the investment losses, they would be being asked to do that at the exact same time that they were facing revenue pressure. That's a very real risk. It's not our baseline scenario, but if it were to occur, that's just the way that these things have tended to go hand in hand. Looking back to say, 2008, 2009 time period, you had both the pension assets declining dramatically at a very difficult time for budgets, irrespective of what was going on at the pension fund.
That's making me think about one. There's gonna be one more question that I'm gonna ask you, Tom, and it's what we were just talking about is leading me to think about why it is, and you mentioned this, and one of the other um, questions that when answering one of the other questions that I asked, and I should have kind of double clicked on that then, but now it's making me think now with interest rates. You know, I'm talking to the investor universe about these generationally attractive interest rates on the tax exempt side. I mean, interest rates are not just higher, but they're much higher than they were a few years ago. It's making high quality bonds. Um, again, they're at generationally attractive levels. Why is it that we haven't necessarily seen kind of broader de-risking into high grade fixed income from the public pension and from public pensions plans?
So this is just kind of my view is that de-risking would require higher contributions and immediately so.
Hmm.
So remember, earlier in our discussion, I mentioned that unlike the way we view the liabilities, when public pension systems are doing their accounting or their actuarial valuation process, they're using the assumed rate of return on their investments as the discount rate assumption. So if you have meaningful de-risking on the asset side, it forces the reported discount rate to go down. And that, everything else being equal, forces contribution requirements up.
Yep.
And so I think, there's just the incentive there against to do too much de-risking because it would add cost pressure to the plan sponsors. And then, I think when you also look at the way investments have been performing recently, public pension systems, might make a strong case that, our risk on portfolios have been generating great returns, right? So um, the sort of flip side to that is if they don't de-risk, which they haven't, and a big market downturn occurs, basically those higher costs arrive anyway, and they've suffered asset losses.
Mhm. So my big picture takeaway from this conversation is that on the one hand, especially compared to the conversations that you and I were having in the last decade, that the public pension picture has improved. I mean, the ANPL numbers that you were talking about at the beginning kind of illustrate that. But the risks themselves, risk overall, I should say, it hasn't disappeared. If anything, the risks have kind of shifted a little. Um, I'm the way that I'm thinking about it is that this is more of a moment for even increased discipline, not necessarily celebration, right? I mean, and on the one hand, and on the other hand, rising equity returns have been helpful, um, but to a degree, maybe they can also tempt some into assuming that elevator or escalator higher never stops and it never goes down. I mean, what I'm hearing from you, Tom, again, correct me if I'm wrong, uh, is watch for the volatility, stress test the assumptions, and don't make a mistake thinking that this near term strength is necessarily like a new law of nature, that there still are risks and you got to pay attention to them pretty closely. Does that make sense?
Yeah, your last statement, especially, I would sum it as saying, I think unequivocally the risks are down, especially compared to a number of years ago. Um, you know, on the budget side, I'll just reiterate the big item to point to is that kind of the structural underfunding of annual contributions is nowhere near as prevalent or material as it used to be. So that's an action that governments have taken in their budgets, and it's been positive for their credit quality in our view. And the unfunded liabilities are down, but the asset risk uh, potential is really the potential trigger point. And if we were to suffer a material market downturn, the pension fund asset allocations leave them very exposed to it. And that would translate pretty quickly into what we would view as probably some pretty difficult cost hikes. And then the point you made compounds it, which is if that occurs concurrently with a challenging revenue environment, all of a sudden, pensions become kind of the focus of budgets again, as far as cost pressures. And
Right.
we've had a reprieve of that in recent years. But really, in our view, that could return pretty easily if we do experience a material market downturn. And that's not our base case. I just want to make that clear.
Right.
But the point is, those asset allocations have not been de-risked to sort of minimize that potential.
Well, thank you so much for explaining that. I appreciate it. I'm sure all our listeners appreciate it as well. Um, Thanks for coming back. We'll look forward to having you come again.
Well, thanks so much for having me again, Tom. I really appreciate it. And Happy New Year to you.
And thanks very much to those who turned in and downloaded our podcast today. We appreciate you listening. Thank Tom, Aaron from Moody's again for joining me. I really enjoyed our discussion. And for those interested, you can also see the recent Hilltop Securities economic and municipal commentary and listen to our other podcasts by going to hilltopsecurities.com/commentary. And you can follow me on X and LinkedIn. Thanks, everyone. We look forward to bringing you more color in the future related to topics that intersect the world of politics, finance, and public finance. This has been Tom Kozlik from Hilltop Securities.